There is a question at the heart of investing that most people never seriously examine. Should you try to pick the best stocks yourself, hire a professional fund manager to do it for you, or simply buy a fund that tracks the entire market and stops trying to beat it? For decades, the financial industry's answer was obvious. Hire a professional, pay for expertise, get better results. The data, however, tells a very different story. It turns out that most professional fund managers, after fees, consistently underperform the basic index they are supposedly beating. This is not a fringe view or an anti-establishment talking point. It is one of the most well-documented findings in the entire history of finance. The SPIVA report, published by S&P Global and widely considered the gold standard for tracking active versus passive fund performance, has shown consistently that over a 15-year period, roughly 90% of actively managed funds underperformed their benchmark index. Over shorter periods, a small number of active managers do beat the index, but identifying which ones will beat it in advance is itself an unsolved problem. Past performance does not reliably predict future performance. So you end up with a situation where most professionals, despite their research teams, their Bloomberg terminals, their years of experience, and their high fees, deliver worse results than someone who simply bought and held a low-cost index fund and checked it once a year. The most famous demonstration of this principle came from Warren Buffett, arguably the most successful investor alive. In 2007, Buffett made a 10-year, million-dollar bet that a simple S&P 500 index fund would outperform any portfolio of hedge funds selected by professional money managers. Only one firm, Protégé Partners, accepted the bet. Over the following 10 years, the S&P 500 index fund returned roughly 126%. The basket of hedge funds returned approximately 36%. Buffett won by a landslide, and he has recommended index funds for ordinary investors in multiple Berkshire shareholder letters. When the best stock picker in the world tells you to buy index funds, that is worth paying attention to. Why do index funds win so consistently? A few structural reasons. First, fees compound just like returns do, and actively managed funds typically charge between 0.5 and 1.5% per year, while index funds can be as low as 0.03%. That gap sounds small, but over decades it becomes enormous. Second, active managers trade more frequently, generating tax drag that further erodes returns. Third, the market is actually very efficient. Prices already reflect most publicly available information, which means consistently finding mispriced securities is extraordinarily difficult. When you buy a total market index fund, you own a tiny piece of every company. When any company succeeds, you benefit. You do not have to predict which one. Getting started with index fund investing is simpler than most people realize. You need a brokerage account, or even better, a tax-advantaged account like a 401k or Roth IRA. Inside that account, you buy a broad index fund. Options like the Vanguard Total Stock Market Index Fund, the Fidelity Zero Total Market Index Fund, or any S&P 500 index fund give you diversified exposure to hundreds or thousands of companies in a single purchase. You then set up automatic contributions, whatever you can afford consistently, and stop obsessing over short-term price movements. The strategy is almost embarrassingly simple. Simple is exactly why it works. You are eliminating the human errors that active managers and individual stock pickers consistently make. The research is clear, the logic is sound, and the results over multiple decades are compelling. Index funds will not give you the thrill of picking a hot stock and watching it go up 50% in a month. What they will do, with high probability, over a long enough time horizon, is outperform most professional money managers and build genuine wealth for you in the background while you live your life. The average investor who stays in a broad index fund through market cycles, who does not panic sell during corrections, and who contributes consistently will almost certainly end up ahead of the vast majority of people who try to be clever. Stop trying to be clever. Buy the index. Stay the course.